All right, let's see. We're live. All the socials, at least some of the socials. Still looking for all that. Um, Actually, let me test the microphone. Oh, once again, my platform decides to change the mic on me for no apparent reason.
Whatever you're using now sounds really good.
Does it sound better?
Yeah, actually, you're clearer on whatever mic it's using than you normally are.
Yeah, they decide to mess with my settings. Gotta love these platforms. They decide what's right. That's the way tech works. They decide what's right for me. All right, we'll get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Happy Friday, Kirk. Good to see you again. It's been a couple weeks.
Yeah, happy Friday. Happy Friday. Well, a lot's happened in the last 2 weeks since Trump's got elected. I feel like every day is a tidal wave of new stuff, good or bad, depending on what side of the issue you are. But I do find it fascinating. I don't think I've ever seen anything like this, where, I mean, just every single day there's something new. And I've been noticing, just kind of share this because it's been fascinating to me. I think for politics for a long period of time, they've tried to put people in a lukewarm pool, right? Just make everybody comfortable. Let's not rock the boat. We're going to do some things here, some things there. We'll do some things behind the scene you don't see. We're not going to try to rock the boat because we want to get people upset. Trump has decided to do whatever the heck he wants, and he's coming in and he's issuing executive orders every day. Now, personally, I like what he's done so far. I know some people disagree. Some people watch corporate media, probably violently disagree. I would recommend just stop listening to corporate media because they're just nonsensical nowadays on both sides. This is not politics. Just both sides are nonsensical. Make up your own mind on something. Because what I've found is most of the stuff, I think what they're doing is low-hanging fruit, simple stuff. But I think they're going to get to a point, if they keep this pace, where they're going to start getting some stuff that is controversial. And I know there's probably some controversial stuff. I'm not minimizing that. But for the most part, it's been low-hanging fruit. Stuff he's said he's going to do, which you might not have liked, but he's doing what he said he's going to do. So what that tells me is his first term, he was more of the normal politician. Well, I want to do these things. I want to build the wall. Well, did he build the wall? No. Right. And so I think he was the first term president. He was a normal president of, I'm just going to, be a normal politician. This time, I feel like we both know what we're going to get and don't at the same time. I feel like we're going to get exactly what he advertised. And at the same time, I also feel like I'm generally supportive of what he's doing so far. I put myself in the cautiously optimistic camp, meaning that I think directionally he's going in the right direction. Will it end up being a good idea? We'll see. I don't know. I'm cautiously optimistic. I'm cautiously optimistic about the economy, which is what we're going to be talking about a little bit today. And so I'm cautiously optimistic. Could it go horribly wrong? Absolutely. We've been talking about in the show about some of the things that he's doing that are inflationary, which is a bad thing. He also wants to lower rates, which is also a bad thing if you're worried about inflation, right? So those are problems. So at this point, I see those as problems, but I'm giving him the latitude to make the mistakes and to see maybe he comes up with a solution, because he's mentioned a few things that I thought were interesting solutions, and I'm going to wait and see, because I don't agree with them, but I'm going to give him the slack to make them, because he's got a lot of smart people around him, people who are smarter than me, who may have a different opinion. And it's not that I'm saying it's a bad idea. I'm just saying I haven't been convinced that's a good idea. So there's a few of those out there, which I've mentioned in the last few weeks. I'm cautiously optimistic, but I also want to hear I want to hear the story. I want to hear the reason. So I can make up my own mind if I agree or not. It won't change the direction, but I don't want to make up my mind based on what somebody else is telling me. I want to hear them actually say, all right, here's what's going on. And I can say, oh, okay, I get it. I disagree. Or, oh, I hadn't thought of it that way. I agree. And that's what I think the way it should be. We should all be thinking that way, but most of us get caught up in the media and what they're telling us what to think. And I think it's unfortunate, because most of them are just propaganda at this point. I want to talk about a mental model to start with. Okay, I'm going to share a picture I saw on LinkedIn, and here's what it says. Basically, Ingrid and Patty bought a house. Patty lived in it. Ingrid rented it. All the same stuff. And the difference is that because Ingrid rented it and she makes a positive $491 cash flow a month, and her investment grew $1.45 million after 30 years. Now, Patty, who lived in it, her cash flow is negative $1,509 a month. And her investment growth after 30 years is negative $238,964. And what it says at the bottom, primary home is an expense, investment is an asset. Now, on the surface, this is what everybody says. You know, real estate's an asset. It's not an expense. What's wrong with this, Doug?
The what's wrong with the fact that everybody calls real estate?
With what I just laid out. With the image I just laid out. What's wrong with that?
What's wrong with that? What basically is you need a place to sleep. You still own and control the asset, that you've got. I think you really can't compare the two. I talk to families about this all the time. You need to have a place to sleep. And what you're going to do is you're going to end up paying for a place to sleep no matter what you do. But ultimately, you're constantly paying for that place to sleep. Even if you pay off your mortgage, you're still going to have property taxes. Talk to people in Texas. You're still going to have utilities. They're going through the roof. I don't know what you're paying now, but mine have doubled over the last couple of years. You're going to pay for all the electricity, all the expenses. And obviously, if you're renting it out, then you get to have someone else pay at least the mortgage, and in many cases the expenses, because you're not going to be in there using utilities. Whoever's living in there is going to be paying those utilities. So my view in this has always been they're completely different things. But the only way to really look at real estate is when you compare real estate in the same sector. So if I'm going to rent and be the renter of real estate versus owning a home and being the renter of my home, basically is what that is. Or, that's the apples to apples. Investment real estate is a completely different category because that is now a place you've put your money to work. It is not where you are, it has nothing to do with whether or not you're going to sleep. But unfortunately, there is some views out there. A lot of people do view that their home is an investment. And at the end of the day, the home you buy still has equity. It still has capital. It still has usability. So if we take that purchase price of the home,
let me get back to the example, Doug. You answered my question. We'll get back to it. So I want to point this out as a chart crime, even though it's not a chart. The reason I point out is because we hear this all the time. We hear all the time, you need to own a home. You need to rent. A home is an investment. And you need to understand it's only an investment if you treat it like an investment. If you live in it, it's a personal expense, right? It's a personal expense. If you rent, you're paying, let's say you're paying $2,000 a month for rent, and it costs, what your total all-in costs are $2,000 a month to rent. And let's say you buy and your total all-in costs are $6,000 a month to buy. It costs more to live there. Now, yes, are you getting an appreciation of equity? Probably, right? Most likely. I mean, over time you will, right? And so people say, well, it's an investment because it's going up in value. Yeah, but how much are you paying to maintain it? How much are you paying to live there? Because it's basically you're either renting or you're buying. Either way, you're spending a certain amount of money to live there in your place, and that's great. With rental, if it's the same cost as owning, you should own. If your rent price is like 70% less, you should rent. I've done the math. We have a calculator on our website. Don't overpay just because you quote unquote own it. Now, this is a math perspective, not an emotional perspective. People have an emotional attachment to their home. But from a math standpoint, what you'll find out is you actually do the math, and we've done this. We have a thing on our website where you can go and do the math. You'll see that a home is a personal expense, not an investment. So you need to keep in mind that I know people say this, they're showing this. This doesn't say anything. The investment growth over 30 years is negative $238,000. what? Like, what are you talking about? Like, it doesn't go down in value. Like, so this is like a nonsensical post that frankly doesn't make any sense on the surface. But even if it did, okay, it's still, the investment growth would be the same. Like, it's a house. It's the same house. It's the same investment growth. It's totally nonsensical. So, and also we didn't say, where's Ingrid living? What's she paying for rent? It's probably going to end up being the same. So if you actually look at it, apples to apples, Patty lives in it. She owns it. The investment growth is, let's say, $1 million. Ingrid rents it. Well, where does Ingrid live? She live in a teepee by in the backyard, or does she rent? Well, she rents. She's probably also paying $1,500. So it's identical. So
Yeah.
yes, it can be, but it's not in that case. So we wanted to share this as a chart crime because we don't talk about real estate enough. And for all of those of you thinking your personal residence is an investment, it's not. You could easily, if and to be clear, if you have a property in Massachusetts, at least every state's different, under like 800,000, it is more advantageous to own. If it's over 800,000, it's more advantageous to rent. You know, you could have you could have like a $1.5 million property that you're renting, and it's going to cost you 70% less to rent it than to own it. So why would you ever buy it? Well, because you have an emotional attachment. That's okay. It's a personal expense. It's your choice. But don't do it because it's a quote unquote investment. It's a total farce. Run the numbers yourself. You know, don't rely on me. Run them yourself. I tell you, it's a total farce. Don't listen to stuff like this. It's going to rot your brain. If you want to buy it because you want to own it, that's cool. Like, it's an emotional decision. There's nothing wrong with that. It's a personal expense. But if you're doing it from a math perspective, don't buy into it. It's BS. But you have to do the math. Like, it's not like it's all the same. Like, it depends on the property price, it depends on rents. So do the math yourself. Don't just rely on other LinkedIn posts that are BS. Do it yourself. So anyway.
Yeah. And I was just going to add one last thing. Keep in mind, you know, if you own that house, and especially in, you know, most people being locked in lower interest rates, but even higher interest rates, if you take your money and you are trying to expedite, and I'm happy, I work, you know, we run and show families this all the time. But if you take your money and you are trying to pay off that mortgage quicker in order to create more equity faster, keep in mind that the money that you use to give the bank to pay that down faster, it's gone forever, and you're not getting any return on that whatsoever. And now if you're going to sell off your house and move and downside and not live anywhere, that's one thing. But most people end up staying in their house. Some people will sell and downsize. But the problem with the view of having your residential real estate as an investment or trying to get it paid off as quickly as possible is most people have no interest in figuring out how to tap the equity of it, which means that becomes an asset you can't use for every day. And that puts people, especially retirees, a lot of times in a liquidity crisis. So think about that, about where you're putting your extra money and how liquidity is one of the major 6 major risks that people will face, especially as they get older.
Yeah, I totally agree. So we're gonna touch on this. You know, obviously one of the big points. So Trump has a few major points. Get rid of all the illegal immigrants. He wants to cut the government, and he wants to start, you know, his international policy tariffs, basically making America great again. He's focusing on using tariffs. So I wanted to share this chart. I thought it was very interesting, and it just kind of points out back to 1820 that we had a lot of high tariffs back then, and we have very low tariffs now. Well, let's talk about why. Okay, because you look at this chart and you're like, well, we used to have tariffs, it should be fine. Well, here's the reason. We didn't used to have an income tax. That was started in the early 1900s. And it was started because basically, and this is where the whole kind of like populism and eat the rich problem comes in. Here's why anytime a politician comes in and said, well, it's only going to affect the rich people. You know what? That's BS. It's total BS, and they're lying to you. They're lying through their teeth. And if they don't know that they're lying, then they're just stupid. Because here's what happens. When a government institutes a policy, they start with something like, eat the rich. The rich are going to pay more. Do this. Well, what happened in the early 1900s? That's when the income tax started. They said, oh, it's only going to affect the 1% of the population that are really rich. That's how they started it. They said it's only going to affect like 1% of the population. The rest of you, don't worry about it. What happened? Over time, more and more people got swept into it until the point where they're like, well, everybody's got to pay an income tax. Now we all pay income tax instead of tariffs, because tariffs prior to that, you see it was like, 20, 30, 40, upwards of close to 70% at one point. I'm not saying it's right or wrong. I'm just saying that was the acceptable method of taxing people. You taxed the goods when they came, through different countries. Now we can argue whether tariffs are a good idea or not. I'm not going to make that argument. I'm just saying, I'm pointing out the fact that this is the history, and you need to understand history to see the impact. Now, we had a guest on the show who talked about an alternative form, which I thought was brilliant. I don't know that tariffs are the best idea. I think tariffs are going to be inflationary. And if you want more inflation, then yeah, tariffs would be a good idea, right? If you want more inflation, then yeah, they should lower rates. Both of those are policies that Trump has. I don't know that they're a good idea. I'm not convinced that they are. I'm willing to listen, but I haven't heard an argument that says it's a good idea. So at the moment, I don't think either one is a good idea from an inflationary standpoint. Now, I think we could handle inflation. We just raise interest rates and just tackle it. Or they institute a policy that offsets the inflation, like cutting all the government. I mean, by the way, if you own real estate in Washington, D.C., sell yesterday. I can't imagine what is going to happen in Washington, D.C. right now. I really can't. If you're cutting the government even 50%, that's going to completely destroy the city. Like, the city is based around graft and pandering to politicians. It's lobbyists, all of it. It's based on all that stuff. So what is Washington, D.C. without it? Honestly, I don't know. I don't know the city well enough, but it's hard to imagine the city's going to do very well if it's mainly based on politics and, the Pentagon, the military. So I'm not making a statement about what's right or wrong, but this is what's happening. So I would not be owning real estate in DC right now. Now, I could see 4 years from now, after this is over, you might want to buy when it's in the dustbin, when it's in rough shape. But right now, I wouldn't go anywhere near real estate in DC right now. I think it's a dumpster fire that's just waiting to happen, and I don't think the rest of the country reflects that. So the deflation that's happened in DC, I don't know that it'll happen in other parts of the country. It could, but I think we need to see a balancing offset of the inflationary effects that tariffs and lowering rates are going to have on the government. So I just want to share that. I mean, we're going to keep coming back to over and over, but I do want to also point out a few other charts here that we see. One is, I don't think we showed this last week. People just don't feel like buying homes. They just don't. Why? Well, one, because they have higher interest rates. And why would you pay the same amount for a smaller house? Like, you just wouldn't. Now, you could argue that people have a lot of equity in the smaller house. They'd have no mortgage. Okay. But let's just say everything, all else being equal. If you move anywhere, even if you move up, you're going to be paying twice as much right now than you were before. So there's not a lot of reasons to move. And so the real estate market's frozen. And that's kind of a bit of a problem if you're trying to get in. So the starter homes, hard to buy. If you're trying to retire, also. So everything's getting squeezed in the middle. And if you think about like a process, you always have new people come in, you always have new people going out. They're upsizing, they're downsizing. So you got this curve. Well, the problem is the curve keeps pushing and no one's leaving, right? No one's leaving the party, right? The party's still going on. No one's leaving. You're like, come on, everyone out. They're like, yeah, we're just going to stick around. Screw you. And it feels like that with the real estate party. And so people in the beginning, they can't get in because there's no room. And there's no room for them to buy starter homes because it's too expensive. I would really like to see that whole process change. I would really like to see the real estate market have a little bit of volatility, let's say. I know we're starting to see some things in some of the southern states, but I'm not seeing it here. And we'll have to see what happens with interest rates. But I think we really need to fix some of this stuff, because if not, the problems are just going to keep building and building until, I mean, what do you do? Let me give you an example. So what do you do if you're a 30-year-old, you just got married, and you want to buy a house? And normally you'd live in a certain suburb that you want to live in, school systems and all that. But what if you can't afford to live there? Well, now you got to move further out from the city. And the people who are living there, they're not sending their kids to the schools because they're older and, like I can't move. So I'm just going to stay here. So, it disperses people a lot more. They're living in places they don't want to live. It's a lot more inconvenient. And so it changes the pattern that everybody's accustomed to, which is, it's a big problem, right? You're changing the pattern. Just like COVID changed the pattern. People aren't living in the city. They're moved out. We moved out. A lot of people moved out. Like, why would you live in the city in COVID? You want to have your own yard. You want to be able to walk around, not stuck in your home. So it changed people's patterns. And now companies are finding it hard to get people to get back to work. They want to, Doge is talking about the federal government, get back to work or you're fired. I think that's great strategy. Corporations can't do that because they can't find employees to replace them. So they got to manage the employees because the crazy people are in charge of the sane asylum. I mean, corporations, if they have a rebellion on their hand, they can't do that. They can't just fire everybody. So, I mean, it's a big battle. And so I don't know what's going to come of it, but certainly a lot of patterns are changing. And so the next 4 years is going to be really interesting to see where that goes. What else, Doug? What are we missing here? I know I'm flipping through a bunch of charts here.
Yeah, well, I would say that one thing. It's one thing if you were looking at the government that is trying to downsize people, but like you said, the private sector is actually trying to keep people because they need them to do their job, and that's going to be a much more difficult proposition than just mandating people back. A lot of those people don't live anywhere close to it anymore. They've already moved. I know up in New York that happened. A lot of people moved away from the city into the Catskills, and and now trying to get them to come back. That's some of the ones that I know that moved there ended up moving down to South Carolina. They moved to Charlotte. So people are trying to move and be where they are happy because now, especially, they can work more remotely. Zoom has really pushed that a lot. Even what I do with a lot of my, most of what I, meetings that I have are virtual as well. And, we don't have, and that's when the impact that's had on commercial real estate. I will say that I want to go back to the mortgage conversation. I have a chart here that shows that talks about, again, if we're talking about the cost of housing, it's probably a good timing on that. But some Americans may not be able to afford a mortgage with a regular 9-to-5 job anymore. According to this data that they came out with, posted by Visual Capitalist, based on median hourly wages and home prices, assuming a 30-year mortgage and a 5.8% mortgage rate, 6% down payment, which I thought was interesting. I don't know, most people are still under the mindset of 20% down payment, but according to that, the number of days that it takes of work to be able to afford that monthly payment, in many cases, we don't get all our cash flow all at once for the year, right? We get it, as per paycheck. Well, it takes, where I live in Minnesota, on average, it takes about 12 days of work, average, at 8 hours a day, just to be able to afford the mortgage payment. If you're living in California, that spikes to 28 days, Kirk, of required work just to afford the mortgage payment. I don't know about you, but how many more days in the month does that leave?
February is going to be a tough month, especially if we don't have a leap year, Doug.
Right. February is looking really tough there. Hawaii is 33 days, which last I looked, I don't remember any 33-day monthly calendar. So
yeah, how does that work?
Yeah, I think that's called living in Hawaii and constantly being behind. The best state that I've seen in the country, at least according to this, it looks like the minimum amount of days it would need to work to afford the mortgage is 9 days, and that is equal in Oklahoma, Arkansas, and Mississippi. Alabama's 10 days. I didn't think Alabama would be more. Louisiana's 11 days. Where you are, Kirk, take a guess. I was a little surprised at the number of days it takes to afford a mortgage in Massachusetts.
I'm not surprised, Doug. I live here.
I actually a little surprised. 18 days. I was thinking more, but maybe Western Massachusetts is helping.
Yeah, Western Mass is offsetting it quite a bit. Yeah.
It must be quite a bit. So, yeah. Anyway, so clearly that is when you talk about a young couple trying to work, they're working 2 jobs, they're trying to be able to get their first place. There's nothing available. and half the month is just going to afford the mortgage, it makes it very difficult to put more there. The other thing is, of course, if you're going to be working those number of days, I do have some data here that I thought was interesting on most stressed industries, Kirk. If they're going to be working those double jobs trying to afford that, might be good to not get into a couple different industries if you're going to be able to continue to stay focused. It looks like the industries that are most likely to experience burnout, with 80% reporting symptoms compared to 67, less than 67 for older generations. I do want to say, Kirk, 65% do a burnout rate in finance and insurance. This shouldn't be much of a surprise, especially for those that are really on the back end of a lot of that industry. But hospitality, 80% is number one. Manufacturing, 77. Healthcare, 77 as well. Again, most of these are either hard labor or they're in the service of servicing others. And even though there's been a high-paced innovation, Tech Center actually has reported some of the lowest burnout rates, with 60% of employees feeling overwhelmed. But again, I feel like the more that you are dealing with people or dealing with heavy labor, retail's up there, 75%. Marketing and advertising, high pressure, always been a high pressure industry. Public sector, all of these things deal with people directly, or they're in labor, and they seem to continue to be some of the highest burnout industries that exist. So.
Well, you know what, Doug? If I had a foosball table at my work, I probably would be a 60% burnout like technology too. I need a hot tub, a sleep pod, foosball tables. Like that's the way to keep people from burning out. So I will say this. One thing I've seen a lot of, especially since COVID, and I think this is underrated, is the burnout rate for healthcare. Anyone who's in healthcare for like the last 5 years, you probably concur with this, but it is a tough environment. I mean, from the I forget which company it was, but there was a company, they got hacked. And so instead of doing everything digitally, people had to do things manually, and it was just an absolute nightmare. And the way the system is working, it's just profit motivated. It's just, it's kind of like Washington, D.C. There's so much graft and corruption going on that like everyone's just so sick of it. So I feel bad for people getting in many of these industries, especially healthcare. Now, and these are people who generally just want to help people. There are some people in it for the money, and obviously the money helps, but a lot of people are just doing it because they want to help people. And God, this dealing with the BS that's going on over there, it's like it's almost like, it's almost like the people who thought Obamacare was a bad idea because it would lead to government health care might have been right. I mean, at this point, basically what's happening is the system is so corrupt that it gets to like, well, the government should control it. Which is what happened in Europe. In Europe, you have a two-tier system, which is the poor have a system which is not very good, and then you've got the rich who can pay for whatever they want. And of course, people complain. Well, why can't I get afforded that? Well, that's the way it works if you're in a government system. I don't know what the right system is. I just know that the one we have doesn't work, and it's kind of like what's the old joke? There was a company, and they were losing money every quarter, so they tried to make it up in volume. if we're losing money, let's do more of it. Let's just do more. It'll work. And it's the same thing here. It's like if it's broken, you fix it. You don't just keep doing more of it. And I feel like there's too many people milking off the government teat that I think this is why I like the Doge, what they're doing. I don't know if what they're doing is right, but I like the direction of it. We just need to get back to more free market economy, where people are making individual decisions, where people are coming up with real ideas that have nothing to do with how much the politicians are getting paid, or paying off their supporters. Our system is based on big donors getting their way on both sides, has been for a long time. And I think people are just sick of it. So, I'm glad to see it. I've seen some of the most ardent liberal Democrats who voted for Trump because honestly, they've gotten so sick of what's going on. They just want to wrecking ball the whole thing.
Yeah.
Now, that's from a party that lost, right? They're liberal Democrats. They're not Republicans. And they're like, I'm sick of this. I'm voting for the wrecking ball. And I think that's what most people voted for. And they're probably going to get it, is the way it seems. So we'll see what happens. But I do want to say that, applying all this to finance, right? This isn't a politics show, and we certainly don't want to talk about politics anymore than we have to. But in looking at where things are going, and we've certainly seen some trends. I'm trying to pull some up here. See year to date. So this year we've seen an interesting course of events. Let me share the screen here. Okay, so here's the year-to-date performance of the S&P 500. So if you look here, what you'll notice is tech is not really leading the way anymore. Apple's not, Nvidia's not, Microsoft's not, Google's not, Meta is, which is a little bit surprising because I don't see, I don't know, I won't comment on it, but Tesla's not, Amazon is. Interesting. But, if you look at all the other sectors, many of them are doing okay, right?
Mm-hmm.
So
starting to get a little more, looks like a little more defensive sectors are actually doing better.
Yeah, some defensive sectors. We're seeing some rotation, and there's something that people need to understand about the markets is the markets are a complex beast, and the people who understand them the best are the technicians, because there's some rules of thumb, which are one of them is when you see sector rotation, that's healthy, right? If you see the tech stocks leading and falling and everybody else is just kind of sitting pat, because if you notice the last bunch of years, the market as a whole has generally been pretty flat, but the tech sector has done great, and outpaced everything else. And now you're seeing more of a rotation to other sectors. So you're seeing people rotate into the defensive sectors. You're seeing consumer defensive. You're seeing people move into communications, into healthcare, into financials have been doing extremely well. And so if you start to see these, you start to realize, okay, maybe there are stocks that aren't tech related. Maybe, maybe, there are companies out there, go figure. And some of the companies, looks like Uber and Palantir's had a blockbuster year. I think they're up 53% this year. They had a blowout quarter. So there are some companies that are killing it, but generally we're not seeing the same kind of market that we saw last year. And so as you kind of look through this, what you need to figure out is, am I still betting on tech, or am I betting on the fact that maybe some of these other companies will catch up? I personally think the market is still way overvalued. I still think that if you're looking at investing, you have to really be mindful of what's going on in the world. Let me pull up the world. Oh, sorry. There's the world. So this is year to date, looking at the world. So there's Canada. The US is not on here because that was the other one. But, the rest of the world's actually doing okay this year. They're having an okay year. If you look at China, they've actually done really well this year, although they came off a really, really bad year. So it's, when you're at the low point, it's really easy to do well. If you look at Europe, they're doing pretty well overall. So, we go through these cycles in the market, and we've gotten so triggered to focus on the US because it's been so good for the US for so long. And they're talking about tariffing everybody, but yet look at the world. They're doing great, and we're talking 1 month in, and we're seeing some really big wins. We'll ignore China because they came off a low, but everywhere else in the world, these are developed countries for the most part. And they're mostly doing well for the big companies. India is not doing as well, but most of the other ones are doing fine. So, if you look at the S&P, okay, there's some good, there's some bad, right? But I think it's helpful to understand that it's not just the US. And while diversification is really a tool to prevent you from making mistakes, it's basically I don't want to characterize people, but it's insurance for people who aren't good at investing. which is 99.9% of the people, by the way. There are very few Warren Buffetts out there. So Warren Buffett can put all his money in like a handful of stocks and do fine. And there's a handful of people who can do that. Most people can't. I would never do that. Doug wouldn't do it. Most individual investors should not do this. You should not put all your eggs in one basket. It is dangerous because you're not smart enough to do that. Now, if you're investing in a private company, you have your own company, you're running it, you've got a few companies, you're good at it, you know how to make money, sing and dance, you can do that, right? There are people that do that, right? Like Ned Johnson, who owns Fidelity, started that company. It's still private. He's invested in a lot of other companies and startups and whatever, but all his money was made in Fidelity. He did a good job. And why he's trying to expand beyond that is probably because he's limited in the financial service space. But realistically, we have to be looking around beyond the U.S. borders. Tariffs. Remember, and here's kind of something to rule of thumb. Whatever you think logically makes sense. Like, remember when they came out with Obamacare and people were like, oh my God, the hospitals, the healthcare system is going to be a mess. What was the best performing sector right after that, Doug? Healthcare.
Yep.
Healthcare and health insurance. Some of the best performing sectors after Obamacare, after people said it would be a mess. Why? Because Obamacare basically built in the fact that everybody can build in a profit. Doesn't matter how expensive it gets. They don't have to worry about expenses. They can make more money every single year. They just have to bake in a profit. Well, it doesn't matter. And you know what? You know how they make more profit, Doug? If you're making 8% profit a year, how do you make more money? You grow the pie. You increase the costs. So instead of making 8% on $100, you make 8%, $200, now making 16. Still 8%, but now the pie's bigger. So the incentive structure was wrong in that. And the same people who said, well, Obama's going to take your guns. What were the best performing sectors? Gun companies.
Yeah, absolutely.
Because everyone was going out there buying guns. So we typically think logically about certain sectors. Well, Trump's going to do this, so we shouldn't do it. Honestly, I'm not betting on international because I'm not in love with a lot of the way that other countries are doing things. But if I had to guess, if I had to flip a coin and say, like, bet, what my odds are, I would bet that internationals do much better this year than we think. And it's going to be because that basically they've accounted for all this. And I don't know what it'll have to do with. But the point being is I'm willing to bet that internationals do much better than we think. Yeah. Because we're betting on the fact that, well, it's going to be internationals get harmed. I'll bet they don't. I'm not putting all my money on it, but I would guess if I was making odds, I would guess they would do better. So just some things to think about. Don't tie all of your investments to logic, because logic rarely works in the market. There's always forces at play that are well beyond your logic. And if you think about logic this way, if you're thinking about it, most other people are too. And that means you're in the crowd, which means you're probably wrong.
Yep.
So just something to think about. This is why price is important. If you look at price is the final arbiter of what is correct. Because if you say, well, I want to short the market because it's expensive and it should go down, and it keeps going up, it means you're wrong.
Yeah.
It means you're wrong. Bite your ego. Be wrong. It's okay. Set position, move on. Because this happens a lot. We all make mistakes. Let your winners run. You got to cut your losers quick. That's kind of the rule number one. You got to do it, or else you're going to get dinged real hard, and it's just the way of things. So what do you think, Doug? What else should we talk about today? I know we got kind of a light week because there's nothing going on with presidential executive orders, but we're not talking about that. So what do you want to talk about? What do we got here?
I'll say real quick, speaking of the what's going on with Doge, it's interesting, food for thought. So back in, looking at kind of the control of wealth, because we were talking about, we were talking about that a little bit of time, the 1%ers share of U.S. wealth over time. Back in 1989, 22.8% of total U.S. net worth was held by the 1%. No surprise to anybody that it has gone up by 2025. So it has been 36 years since then. The percentage of net worth held by the top 1% is now 30.8%. So I don't think anybody would be surprised that it is higher than it was then. I think there might be some surprise that it is, as at least according to the Federal Reserve, it's lower than people would think. I think there's been a lot of talk about how much the 1% has been, consolidating the wealth, the wealth. They still have under a third of it. Of course, that is well beyond a quarter of it that they had before. But I think that, if you listen to some of the talk that's out there of that top 1%, it would make it sound like, they control 50% of the wealth that's out there. Going back to the tariffs conversation for a second, I thought this was an interesting one, just kind of in people's opinion, what Americans think of tariffs on Canada. 38% of people think it's a bad idea to some degree. 28% of people think it's a good idea to some degree. 19% think it's an okay idea, and 15% don't know enough to say. So those that think that putting a 25% tariff on Canadian-made goods imported in the United States is a good or bad idea, there is a slightly higher number of people that are reporting that they feel it's bad. This is a 1,500 eligible voters in the U.S. Conducted by Abacus Data. Now, 21% think it's a very bad idea versus 17% think it's a bad idea. That's how they get the 38%. Of the 28% that think it's good, there is a much lower amount of people that think it's a very good idea. 11% think that versus a good idea, 17%. But overall, those that are just cheering, let's put on the tariffs, as you said, Kirk, you have some mixed thoughts on that. I would say that, if 19% say it's an okay idea, and we add those into the goods, that puts us right around 47% think that it's actually a decent idea, which still puts 53% of people either say they're not sure or they think it's a bad idea. But around, that's starting to put us around 50-50 people that think these tariffs are going to be a great thing. So there's pros and cons to every one of them in terms of how that might impact. And we had a lot of tariffs that already went in 2024. I was looking, on tariffs on China. They actually had shown, I'm trying to find the chart. I don't have it in front of me right now, but they were showing roughly about 100% gain or 100% tariff on electric vehicles that went in place in 2024. So that was already in effect. Again, I can't find the chart now on the rest of them, so I apologize, but they are, so there was a number of them that actually went in place in 2024. So it's not like adding tariffs is exclusively new to the current administration. It's something that we've been playing around with, even previous to, the new administration. Obviously, the new administration is making this a very public conversation. So.
Yeah, there's some interesting things. We'll wrap it up here in a minute, but there's some interesting things I saw recently, which there's this chart here, which is the percentage of land that's federally owned in each state. And if you look at Nevada, it's 85% owned by the federal government. I had no idea. That is so weird. 85%.
All national park, it must be.
I know, but if you think about Nevada, look at it's just one big desert. I mean, I know they own some military facilities and stuff like that, but 85%? I mean, I haven't spent that much time in Nevada, but it was just shocking to me. Utah, 65%. Idaho, Alaska in the low 60s, Oregon, Wyoming, California. On the low end, Connecticut, Iowa, New York, 0. Kansas, Rhode Island, Maine, Nebraska, Illinois, Ohio, Massachusetts, 1%. So yeah, it's just really interesting. I assume some of it's state owned in some of these states, some of these states, I would imagine Maine has it's state owned because there's a ton of wilderness up there. So I wonder who owns it. But I just thought it was an interesting stat that if you look into what potentially could happen in this government, I will point out one thing. They've come out with an executive order in the last week that they're going to set up a sovereign wealth fund. Now, I want to talk about this, but I don't want to get too much in the weeds. and then I want to talk about the first years of a presidential election and what that tends to look like. So here's something to think about. The sovereign wealth fund can have many different purposes. For Saudi Arabia, it's, well, we're going to pull all the oil out of the ground, and then we'll be sitting there in tents because we spent all our money and now we got nothing left. They're smart enough to know that years ago, and what they did was they basically put a lot of the revenues into a sovereign wealth fund, and then they use that to develop they have a lot of business dealings, but they use that to develop the country and to put investments into other countries and other areas. So they're basically diversifying their wealth around the world, which is smart, right? It's a smart thing to do. You've got countries like, I think it's Norway has a sovereign wealth fund, and it's primarily due to the oil. They put the oil revenues in there. So on the surface, and we had a guest on our show that talked about sovereign wealth funds, and I actually got an email from last week. He was excited. So on the surface, it's a great idea. I've got tons of questions. So it could be, so for example, let's take TikTok, because I think Trump's been tweeting on this. Let's take TikTok. So people have been talking about, well, should we own TikTok or whatever? Well, there's a bunch of different scenarios. So one is we force TikTok to sell the U.S. operations to one of the tech bros, which I think is a bad idea. But we force that to happen, then it's domestic. Well, it just means we have domestic manipulation. I don't love the app, but anyway, I got kids who are on it, and I don't want them using it. But anyway, so we've got that. Maybe what they do is they sell it into a sovereign wealth fund, so the U.S. owns it. Okay, that would be interesting. I still don't like the idea, but it's interesting. And then the U.S. invests in it, and now the sovereign wealth fund appreciates in value. So here's the good and the bad. The U.S. right now is basically incentivizing people through tax credits and other incentives to do certain things. Like to buy a house, you get a tax deduction. If you're going to start a business, you get a tax credit. Like all these things, they're incentivizing behavior. But what if the government started taking a piece? Well, now you're heading towards a really sticky situation where the government owns businesses, and the government should not be running businesses. Let's be clear. I don't care if Elon Musk, one of the smartest people in our time, if not the smartest, I don't care if he's running it. At some point he won't. And that's the problem. Like, and we always have to look at 10, 20 years in the future we might have the best and the brightest now. You might disagree, but it doesn't matter. Like, let's assume they are. At some point, they won't be there. And someone else will run it, and they will probably be as dumb as most of the politicians we have. So at some point, that becomes corrupt. So my concern with the sovereign wealth fund is who's going to be running it. It might be fine now, but 10 years from now, it'll be somebody else, and it'll probably be a corrupt politician. And then we have US aid all over again. Oh, we're just going to dip into the sovereign wealth fund, and the CIA will use that to fund their shadow ops. So while I think on the surface it seems like a good idea, in reality, I think it's going to be a boondoggle, and I think it's going to be a really bad idea unless they can come up with a way to keep it from being a piggy bank for politicians to do their own stuff. So I want to get more into the sovereign wealth fund, but I want to hear more about what that is going to mean, and I need to do a little digging as to what people's thoughts are in the U.S. I'm going to share these two charts. Let Doug wrap it up. All right, so here we go. This chart is post-election. This is typically how stocks do. We're looking at a bunch of data before and after. So leading up to it tends to do well. The median is the gold line, and the black is recent. So median, things lead up to the election, and then about 100 days after the election, then they peak out, and then they just kind of go sideways for another 100 days. So that's kind of the median. Now we've had a big run up. So pretty much at this stage, we're probably looking at sideways motion. So I don't know if people remember my prediction earlier was we have a 7 to 10% year, and that's the expectation. I think that would be a good expectation to have. If we look at this, here's the 3 years of a bull market, which is not related to the election, but it's a way to compare the average compared to what we're doing. So I think that the way people should be looking at the market now is cautious optimism. I'm not pessimistic about the future of our economy or our stock market. I'm not. But I am cautious because I think things are too expensive. So, what would be a healthy way to approach the stock market is it goes sideways, a little up, a little down, but basically moving sideways for like another year, year and a half. What'll happen there is, so companies, let's say they keep growing at 20%. I know that's a high number, but let's say they keep growing at 20%. And let's say they grow 20% every year. Last year, the market went up 40%. So the valuation's higher than it should be, right? It's ahead of itself. And then the market goes sideways for a year. Well, now the valuations, now the stocks have grown 20%, but the stock market has not. So now it's caught up. So that 20% that it was ahead, now it's break even, right? Let's say it goes sideways for another year. Well, now it's 20% undervalued. So the underlying keep going up, and the stock market typically does. But if it doesn't, it goes sideways, that would actually be really healthy. And I think would allow people to make good decisions to buy stocks at a cheaper level. That would probably be the most optimistic scenario I could see, is that we had a big run up, we go sideways for a few years, and then we start to take off again. Now, no one wants to hear that because everyone wants to make big returns every year, but I think honestly it would be healthy. Because the other opportunity is, well, the stock market crashes 30%, everyone loses money, and then it bounces back, a year later. That's not fun. Nobody wants that. So that would be my recommendation. That would be my recommendation for the stock market gods to take my opinion and do it. But of course, they're not listening to me. But anyway, you should think about that for this year, because if you're assuming things are going to go through the roof again, you might be right. I wouldn't put a high probability on that. Doug, let's wrap us up, and we can head out here.
Well, Kirk, I appreciate it. And for those of you listening, and thank you very much. As you know, I talked about the mortgages earlier, and paying in our house, and taking extra money and paying it towards a house. And where does that money go? It goes off your balance sheet to somebody else's. You don't get it back, and you're never going to recover that. And therefore, it really does reduce your future balance sheet. You're transferring not only the money that you have, but you're also transferring any of the money that it could have become. And this is really a philosophy that should be looked at for any major purchase. And where I come from, I look at areas people are losing money unknowingly and unnecessarily. And for those that have been listening, that in many cases, this is college planning. People lose money, trying to pay for it. You only have two options. You're either going to pay for it cash and assets, or you're going to borrow. And if you pay for those cash and assets, that money is gone forever. And a lot of times, especially those of you in high income brackets, you're paying for that in after-tax dollars. So there's a lot of things that you can do, not only just the free money and the scholarships and the grants at different schools, but there's a lot of mistakes that you can avoid that could actually significantly drive up those college costs. And there's tax credits. There's different strategies you can do to lower the actual cost of money. You can apply your money in ways in which you're not giving it away, and you can actually use strategies that could potentially give you some, if not all, of the money you're going to pay back as a refund. If you want to learn more about that, reach out to us at mergentcollegeadvisors.com. That's MERGENT, mergentcollegeadvisors.com. This is a really important conversation, especially, even though it's not thought of this way, especially for high income and high asset individuals, where you stand the most to lose.
Yeah, thanks, Doug. Thanks for coming on. And that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.